On March 10, 2023, Silicon Valley Bank held $209 billion in assets. By March 13, it no longer existed. $186 billion vanished in 48 hours, the second largest bank failure in American history. But here's what nobody tells you. The collapse itself is just the opening scene. What happens next, in the days, months, and years that follow a bank failure, reveals a pattern so consistent across history that once you see it, you'll never view the financial system the same way again. Today, we're going to trace the anatomy of a bank collapse, not the dramatic headlines or the panic in the streets, but the methodical, inevitable sequence of events that unfolds afterward. From the immediate aftermath that hits depositors and businesses, to the ripple effects that reshape entire economies, to the patterns that emerge across centuries and continents. This is about what happens when the institutions we trust to hold our money simply cease to exist. To understand the aftermath, we first need to understand the mechanics of failure. Banks don't collapse like other businesses. A restaurant closes, and customers find another place to eat. A manufacturer shuts down, and competitors absorb the market. But when a bank fails, it's fundamentally different, because banks don't just provide a service. They hold the accumulated trust of thousands, sometimes millions, of people. The architecture of modern banking rests on a simple but precarious premise: fractional reserve banking. For every dollar you deposit, your bank keeps perhaps 10 cents in reserve and lends out the remaining 90. This isn't fraud, it's the foundation of how credit creation works in developed economies. But it creates an inherent vulnerability. A bank becomes insolvent when its assets, the loans it's made, the securities it holds, fall below the value of its liabilities, the deposits it owes. Sometimes this happens slowly, as bad loans accumulate. Other times, it happens with shocking speed, triggered by a mismatch between short-term liabilities and long-term assets. Silicon Valley Bank, for instance, held billions in long-term treasury bonds. Safe assets, theoretically. But when interest rates rose rapidly in 2022 and 2023, the market value of those bonds plummeted. The bank was holding assets worth far less than what depositors believed they could withdraw. But insolvency alone doesn't kill a bank. What kills a bank is the loss of confidence. The moment depositors believe their money isn't safe, they rush to withdraw it, all at once. And because the bank never had all the money to begin with, it cannot satisfy everyone's claims simultaneously. The bank run becomes self-fulfilling prophecy. This is where the triggering event occurs. Sometimes it's a leaked memo, a regulatory filing, a rumor on social media. In 2023, Silicon Valley Bank's collapse accelerated at the speed of digital banking. Venture capitalists sending text messages, depositors initiating wire transfers from their phones. What took weeks in 1929 took hours in 2023. And then, the bank fails. Regulators step in. Doors close. And the real story begins. The first 24 hours after a bank failure are characterized by a single word: confusion. Depositors wake up to find they cannot access their accounts. Businesses discover that payroll cannot be processed. Automatic payments bounce. Credit cards linked to the failed institution are declined at checkout counters across the country. For individuals with deposits below the insurance limit, in the United States, that's $250,000 covered by the FDIC, the disruption is temporary but acute. Within days, they typically regain access to their insured funds, either through a successor institution or direct payments from the deposit insurance fund. But, typically, masks considerable variation. After the 2008 collapse of IndyMac Bank, some depositors waited weeks for access to their money. Others faced months of uncertainty about uninsured amounts. The real economic damage from bank failures concentrates in three areas: uninsured depositors, credit contraction, and systemic contagion. First, uninsured depositors. Anyone holding more than the insurance limit faces immediate loss. After Silicon Valley Bank failed, this meant tech startups that kept $5 million, $10 million, $50 million in operating accounts suddenly couldn't make payroll. Biotech companies couldn't pay for clinical trials. The FDIC's initial position was that uninsured depositors might recover 50 cents on the dollar, eventually. The potential for cascading business failures was so severe that regulators invoked emergency powers to guarantee all deposits, insured or not. But this was exceptional. History shows that uninsured depositors typically recover 60 to 80% of their funds, distributed over months or years as the failed bank's assets are liquidated. Second, credit contraction. When a bank fails, it immediately stops lending. Every line of credit it extended, every mortgage application in process, every small business expansion plan financed by that institution, frozen. But the impact extends beyond the failed bank itself. Surviving banks, watching their competitor collapse, become suddenly cautious. They tighten lending standards, increase reserve requirements, and scrutinize their own portfolios for similar vulnerabilities. The aftermath of a bank failure is always a credit drought. This is where the macroeconomic consequences become visible. In the year following Silicon Valley Bank's collapse, venture capital funding for startups dropped by 46% compared to the previous year. Was this solely because of the bank failure? No, but the failure accelerated and amplified existing trends. When the institutions that finance innovation become risk-averse, innovation itself slows down. Third, systemic contagion. Bank failures cluster. When one bank collapses, depositors at similar institutions begin to wonder, could mine be next? In March 2023, Silicon Valley Bank's failure triggered immediate runs on other regional banks. Signature Bank failed 3 days later. First Republic Bank saw $100 billion in deposit outflows within weeks and ultimately collapsed in May. The pattern repeats throughout history. The 1930s saw nearly 10,000 American banks fail in a cascading series of panics. The savings and loan crisis of the 1980s destroyed more than 1,000 institutions. But here's what's critical to understand. The aftermath of a bank failure isn't just about money. It's about the destruction of relationships and institutional knowledge. When a bank fails, the loan officers who understood local businesses are scattered to the winds. The lending relationships built over decades evaporate overnight. A new bank may eventually take over the branches, but it doesn't inherit the judgment, the local expertise, the trust that made lending decisions possible. In communities served by a single dominant bank that fails, the aftermath can resemble economic shock therapy. A 2015 study examined the failure of Oklahoma's Penn Square Bank in 1982, which had specialized in energy lending. The bank's collapse contributed to a regional recession that lasted years. Oil-dependent businesses couldn't find alternative financing. Unemployment in Oklahoma City doubled. Property values plummeted. The full recovery took nearly a decade. This is the hidden cost of bank failures, not just the immediate losses, but the institutional amnesia and the breakdown of the credit relationships that make modern economies function. If you study enough bank failures across enough countries and centuries, patterns emerge with striking clarity. These aren't coincidences. They're the fingerprints of how credit-based economies respond to institutional collapse. Pattern 1. The speed of collapse accelerates, but recovery remains slow. The Bank of United States failed in December 1930 after a month-long crisis. Continental Illinois failed in 1984 after weeks of deteriorating confidence. Northern Rock in Britain failed in 2007 after depositors queued for days. Silicon Valley Bank failed in 48 hours. Technology has accelerated the velocity of panic. Information spreads instantly. Deposits can be moved with a finger swipe. The run in bank run now happens at digital speed. But here's the paradox. While collapse happens faster, recovery follows the same slow rhythm it always has. Economic collapse lessons from history show that rebuilding trust, re-establishing credit relationships, and restoring normal lending patterns takes years, regardless of how quickly the crisis erupted. Japan's banking crisis, which began in 1991, took nearly 2 decades to fully resolve. The 2008 financial crisis triggered bank failures that were resolved within days through government intervention, yet credit markets remained disrupted for years. This creates a dangerous asymmetry. We've built systems that can fail overnight but require years to repair. Pattern 2. The initial response is always, this time is different. Every generation believes its bank failures are unique. In 1930, the problem was gold standard constraints. In 1984, it was oil loan exposure. In 2008, it was subprime mortgages. In 2023, it was interest rate risk and concentrated deposits. And each time, policymakers and commentators insist the lessons of previous failures don't apply because this time, the circumstances are different. But the historical financial patterns reveal a deeper truth. The specific mechanism changes, but the underlying dynamics remain constant. Excessive leverage, concentrated risk, maturity mismatches between assets and liabilities, and most importantly, the fragility of confidence. These elements appear in virtually every major bank failure across 3 centuries. The economist Charles Kindleberger documented this pattern in his masterwork, Manias, Panics, and Crashes. He identified a recurring sequence: displacement, new technology or market, boom, euphoria, profit-taking, panic, crash. The specific details vary. The pattern doesn't. Pattern 3. Government intervention becomes more aggressive over time. In the 1800s, bank failures were largely private affairs. Depositors lost money. Shareholders were wiped out. Sometimes neighboring banks would form a consortium to manage an orderly liquidation, but government involvement was minimal. The Great Depression changed everything. The creation of deposit insurance, first in the United States with the FDIC in 1933, represented a fundamental shift. Governments would now guarantee deposits, preventing bank runs through the promise of repayment. But each subsequent crisis has required more aggressive intervention. The 1980s savings and loan crisis cost taxpayers $124 billion. The 2008 financial crisis triggered unprecedented government actions: bank nationalizations, massive capital injections, emergency lending facilities. How nations recover from banking crises increasingly depends on government willingness and capacity to absorb losses. This creates a moral hazard problem that remains unresolved. If banks know they'll be rescued, do they take excessive risks? The pattern suggests yes. Each rescue seems to plant the seeds for the next crisis. Pattern 4. The aftermath reveals structural weaknesses that were invisible during normal times. Bank failures are diagnostic. They reveal which regulations were insufficient, which risk models were flawed, which oversight mechanisms were captured by industry interests. Silicon Valley Bank's failure exposed how banks could hold massive losses in their securities portfolios without being required to recognize them on balance sheets, a regulatory loophole that seems obvious only in hindsight. The savings and loan crisis revealed how perverse incentives and regulatory forbearance could turn a manageable problem into a catastrophe. The 2008 crisis revealed how interconnected the global financial system had become. Lehman Brothers' collapse in New York triggered credit freezes in London, Frankfurt, and Tokyo simultaneously. These lessons are learned at enormous cost. But they're also consistently ignored or forgotten. The average career of a bank regulator is perhaps 20 years. The average time between major banking crises is also roughly 20 years. This means that by the time the next crisis arrives, many of the people who lived through the last one have moved on. Institutional memory fades. And the patterns repeat. Pattern 5. The social and political consequences outlast the economic ones. The economic aftermath of bank failures can be measured in years. The social and political aftermath can last generations. The Great Depression's bank failures contributed to a fundamental reimagining of government's role in the economy. The 2008 crisis triggered political movements on both left and right: Occupy Wall Street, the Tea Party, and ultimately contributed to the populist wave that reshaped Western democracies in the 2010s. When ordinary people lose their savings while bank executives keep their bonuses, it corrodes social trust in ways that persist long after GDP returns to trend. A 2019 study found that regions most affected by bank failures in the 1930s showed measurably different attitudes toward financial institutions 80 years later. The trauma passes down through generations. This is perhaps the most important lesson. Bank failures aren't just economic events. They're social ruptures that reshape how people understand fairness, merit, and the social contract itself. Oh, what does this mean for you? Not as a policymaker or economist, but as someone living in an economy where bank failures happen, will happen again, and follow predictable patterns. First, understand the FDIC insurance limit and structure your deposits accordingly. This isn't paranoia, it's pattern recognition. If you have more than $250,000 in any single institution, you're taking on uninsured risk. That risk may be low in stable times, but when a bank fails, the difference between insured and uninsured deposits is the difference between inconvenience and catastrophic loss. Sophisticated depositors spread funds across multiple institutions or use accounts structured to maximize insurance coverage. Joint accounts, trusts, and different ownership categories each get separate insurance. Second, recognize the early warning signs of banking stress in your region. Rapid growth in deposits at a single institution. Unusually high interest rates offered to attract deposits, which usually means the bank is struggling to raise capital through normal means. A heavy concentration in a single industry or type of loan. Management turnover. Regulatory actions or enforcement measures. These aren't guarantees of failure, but they're indicators of elevated risk. When Silicon Valley Bank failed, the warning signs were visible months in advance to anyone looking at their public filings. Unrealized losses in their securities portfolio were disclosed. The concentration of uninsured deposits was known. But most depositors don't read bank financial statements until it's too late. Third, maintain liquidity and diverse banking relationships. Point one lesson from the aftermath of bank failures is that access to multiple financial institutions provides resilience. If you run a business and your primary bank fails, can you make payroll? Do you have credit lines at other institutions? Can you quickly establish new banking relationships? This applies to individuals as well. If your checking account, savings account, mortgage, and credit cards are all with the same institution, you have single point of failure risk. Diversification isn't just for investment portfolios. Fourth, understand that deposit insurance protects principal, not access. Even if your deposits are fully insured, a bank failure means temporary loss of access. In a best-case scenario, that's a day or two. In more complex failures, it could be a week or more. Do you have enough cash on hand to weather that disruption? This is particularly important for businesses with payroll obligations or individuals with time-sensitive payments. Fifth, remember that the aftermath of bank failures creates opportunities as well as risks. When major banks fail or become risk-averse, space opens for alternative institutions. Credit unions often gain members. Community banks grow. Peer-to-peer lending platforms expand. The aftermath of the 2008 crisis accelerated the rise of fintech companies that could provide financial services outside traditional banking structures. This isn't to minimize the pain of bank failures, but to recognize that institutional collapse and renewal are two sides of the same coin. Creative destruction operates in banking just as it does in other sectors, though the human cost is higher and the recovery slower. Finally, advocate for stronger oversight without waiting for crisis. The pattern is clear. Regulations are tightened after failures, then gradually loosened as memory fades and industry lobbying intensifies. This creates a boom-bust cycle in regulatory stringency that parallels the boom-bust cycle in the economy itself. You don't need to be an expert to understand the basics. Banks should hold capital sufficient to weather losses. They should be prohibited from taking risks that threaten the broader system. Regulators should have the resources and independence to enforce rules. These principles sound obvious after a crisis but become burdensome and anti-competitive during good times. Breaking this pattern requires sustained civic engagement, not just post-crisis outrage. When a bank fails, the collapse itself is just the beginning. What follows is a methodical, predictable sequence: confusion, loss, credit contraction, recovery. The specific details change with each era, but the underlying patterns remain remarkably consistent across centuries and continents. The institutions we trust to hold our money are inherently fragile, built on confidence and leverage in equal measure. Understanding what happens when that confidence breaks, not just the panic, but the slow, grinding aftermath, is essential for anyone navigating the modern economy. The question isn't whether banks will fail again. They will. The question is whether we've learned enough from the patterns of the past to limit the damage when they do. If you want to understand what happens after other economic crises, from currency collapses to sovereign defaults to hyperinflation, the patterns are just as revealing. And just as ignored. Until they repeat.